Uncle Sam basically took out an adjustable rate mortgage on its future. Well over 50% of our debt matures in the next 3 years, which means that it's part of the reason why interest expense is exploding. We're bullish until the bill comes due. And the bill coming due, in our opinion, is some sort of reckoning when it comes to our fiscal situation. I think the chances of another wave of inflation are not low or not trivial. The Fed's policies, I think, directly led to Donald Trump's appeal to regular people because they didn't feel that they were getting their fair share of the economic bounty.
We've gotten to the end of earnings season and turn our focus to the holidays and the economic outlook for the next year. I'm your host, Andrew Brill. If you need help looking forward financially, go to wealthion.com/free for a free, no obligation portfolio review. We'll talk about where the economy's headed coming up next. I'd like to welcome Jason Trennert to Wealthion. Jason is chairman and CEO of Strategas Securities, also a chief investment strategist, known as one of Wall Street's top thought leaders on markets and economic policy. Jason, thanks so much for joining me.
Thanks for having me. It's a pleasure.
A couple of questions for you. I like to start out by asking people their take on the present economy. So what do you think about the present economy as we sit here right now?
Well, listen, I think the good news is that the unemployment rate is low, and as a result, I would say that kind of lower income folks are still spending. Certainly, the higher income folks are benefiting greatly from the wealth effect, so that's good. I do think, given our fiscal situation, that there are risks in the future, particularly for a second wave of inflation. So I'm a little bit worried about that from a longer term perspective. I do think there's probably some pent-up demand for Capex because of the election. I think there's a fair amount of companies that probably put some capital expenditures off. So probably 2025 looks okay. But we've been telling people, at least as it relates to the markets, that we're bullish until the bill comes due. And the bill coming due, in our opinion, is some sort of reckoning when it comes to our fiscal situation. And that, it depends. There are good ways and bad ways to fix it. Hopefully, we don't have to experience a crisis before we fix it. But normally, that's the way it works. Given politicians are generally put on earth to give stuff away as opposed to take it away.
I know you noted in your research that you sent over to us that now that the election has passed, things have calmed down a little bit. Obviously, the markets went crazy and earnings were at the end of earnings season. You believe that earnings into next year are going to continue to be very good.
Yeah, it looks like it, especially given our view of the economy, which is to say the chances of recession, in our opinion, next year are pretty low. Obviously, profits are in nominal terms. So if you have a little higher inflation, it tends to imply higher earnings. The issue really comes if that higher inflation results in higher long-term interest rates, and then whatever you get on the earnings side, you tend to give back on earnings multiples. But I do think the earnings are probably not going to be as good as what the street is expecting, which is about 14% increase next year. But they'll probably be in the high single digits, something along those lines.
So, and where does that sit with normal? 14% growth is probably a little bit higher than normal. Where does single digits or high single digits, where does that sit in terms of normal?
Well, over the longer term, the normal is about 7% nominal for profits. So we've definitely been over-earning. And a lot of that, I would say, at least recently, has been due to a relatively small group of companies. If you excluded the Mag 7 from the earnings calculations, you'd probably be below normal. So if you took the S&P 493 versus the Mag 7, right, you'd probably be in the 4 to 5% range in earnings growth next year, as opposed to 13 or 14. But those companies are earning so much cash, or earning so much in terms of earnings, but also generating so much cash that it all evens out for the market as a whole to something that's above average.
You mentioned Capex spending. Is that an assumption that interest rates will continue to come down, so companies will be able to borrow to spend, or is that you think that people have some cash around to spend on?
I think they have
spending?
some cash, and I think the range of outcomes from the election was so wide, in my opinion, with the two candidates, that it was pretty prudent, I think, for a lot of companies to hold off on any sort of big capital expenditures until they knew who won. And then they could decide whether they would proceed or hold off or change the plans. So now that it's over and there's some certainty, and I would argue, not to be overly political about it, I think President Trump winning is better for capital formation than if Vice President Harris were to have won. I think all those things bode well for Capex. I'd also say that corporate credit spreads are very, very tight. And so interest rates don't necessarily have to go down, but companies are able to fund themselves at very, very attractive rates relative to history. And so that helps out as well.
So Donald Trump is obviously very pro-corporate and wants to see earnings growth, but we're embarking on a time when we're right up against the debt ceiling. We're going to have to deal with that come January. Are we looking at possibly inflation going back up again?
I think that whoever became president, in my opinion, is inheriting a difficult economic situation. And the reason why I believe that is because we're close to $36 trillion in debt total. About $28 trillion of that is owed to the public. Not only that, we have, and this is both Republican and Democrat administrations have decided to fund a lot of it short. So 50%, well over 50% of our debt matures in the next 3 years, which means that it's part of the reason why interest expense is exploding. Our weighted average cost of debt is lower than every part of the yield curve. So you put all those things together, the good news, I guess, is that the economy is still growing. The bad news, again, is that when you use that kind of debt, you're largely borrowing from the future, unless you get productivity gains, which I do think is a distinct possibility. But whether those productivity gains come in time to relieve us as investors from an accident or higher interest rates or higher inflation, I don't know. But there are a number of things that would argue, I think, for a second wave of inflation.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family. So, you touched on the bond market, and obviously they're using the short-term bonds to fund a lot of this debt, but yet the 10-year, even though they cut the rate a little bit, the 10-year isn't coming down, and that seems strange to me.
Yeah, I think part of that, at least when we've looked at it, at least thus far, at least since the election, let's say, which is just a couple of weeks, most of the increase has come from expectations for stronger real GDP growth as opposed to higher inflationary expectations. So that's good. That's a positive for the equity markets. It's not necessarily worrisome. But I will say, though, again, we've been in a situation where we've been running budget deficits of 7% of GDP on a serial basis for the last 4 years, and that's when the unemployment rate is 4%. We've never done that in America's history. We've only run budget deficits of that magnitude when we were in recession or when the unemployment rate was above 7%. So this is highly unusual, and it's difficult to, like everything else, it's easy to do. It's easy to start. It's very, very hard to stop, right? Because it involves some pain. usually, right? So you're either going to, the new incoming administration, the Trump administration, either going to have to increase taxes, which I think is, kind of their last choice on the list, cut spending, which I think is very high up there, which is positive, either accept higher inflation as just as a fact of life, or again, rely on productivity gains to make the equation work out. The good news is that I think this is the first time in my life, and I've now been doing this longer than I haven't as a human being, so well past the halfway mark. This is the first time I've seen the government actually really serious about cutting spending, and so which is I think it's a very good thing. It's not easy because there are a lot of let's say entitlements or things that are non-discretionary items, but by the same token, even just the discussion of talking about cutting spending is a very positive development, I think, for the country and for the bond market as well.
Would it be helpful? And I know that the incoming President Trump has put together a committee of a couple people to look at budget, to look at cutting. Would it be beneficial to cut to a point where our debt isn't growing but not as quickly, so there is the possibility of catching up at some point? So if they are the discretionary things that you spoke about, I guess they could cut government programs and those things that our tax dollar pays for, but the defense budget and everything else, I guess they're going to look at stuff like that to cut and figure out where can we save some money.
Yeah, I mean, there's certainly, I think, take care of the pennies and the pounds will take care of themselves, that type of thing. So it's just because it's very difficult to cut things like Social Security, Medicare, Medicaid, veterans benefits, defense, interest expense, all of those things are about 80% of the budget. And those are very, very hard to cut without real political pain or real political, debate. The other 20%, though, I think there's a very strong public support for, let's say, having federal workers, show up in the office once in a while. Probably wouldn't be the worst thing. And so I think there's a lot of public support. And I do think that it sends a signal to the bond market that it can't be business as usual, because we're at a point now in which if we don't make changes, the interest expense, which is exploding right now, the interest expense will consume eventually the entire federal budget. Right now, interest expense is greater than defense spending. This year, it'll be greater than Medicare, rather. And that's a result of the fact that not only are we amassing all these debts, but as I said, we funded all of it short. So we haven't locked in one of the great sins of QE in many ways, and I think it was a very bad policy, my own opinion, for 12 years. But we compounded the problem by not locking in our funding longer term. Right. And one of the reasons why corporate credit spreads are very tight is that companies who don't have the ability to print their own currency were very smart in that they funded themselves out as long as they could. In many cases, that's in the 5 to 7 year area, but it gives them a lot more flexibility financially. If interest rates were to go up, they're not necessarily dependent upon short-term funding to fund themselves. And so that's the good news. The bad news, though, is the federal government, as you're pointing out, without changes, without cutting spending, or I think raising taxes would be a disaster. But without cutting spending or getting productivity, it's really hard to bend the curve, as they say.
Yeah, raising taxes would be like an instant loss for Republicans. They worked really hard to explain to you that we need to lower these things, lower taxes, make things better for the average American. That's a recipe for disaster. We did a poll and asked people what's their biggest issue when it comes to spending money. They say it's the economy. The economy is number one on the list. So raising taxes would not help out at all. Now, why in your estimation or your research, why are they short funding the debt and not looking at the longer term? I understand that if they do it with the 10-year, obviously mortgage rates are going to go up, but you could do it with the 30-year and say, look, let's lock in our our profits and be able to pay this debt.
Yeah, listen, the honest answer is I've thought a lot about this. I've spent a lot of time. There's no good reason. There's no good intellectual reason. There are claims that it would be very hard to sell or very hard to hedge long-term debt, but I find those arguments very specious, very, very, very questionable. Mexico issued 100-year paper in euro. Okay, so if Mexico could issue 100-year paper in an untested currency, let's say, Uncle Sam could issue 100-year paper in dollars. But again, you don't have to go out 100 years. You could, as you pointed out, you could go out 10 years, go out 20 years. You could go out a length of time in which you're not dependent upon the kindness of strangers every 3 months to fund a massive debt and increasing deficits. So I've heard all the excuses, but the fact of the matter is it's just more politically expedient because it keeps interest expenses lower. At least that was the thinking. Secretary Mnuchin, under the first Trump administration, talked about issuing 50-year and 100-year bonds. And unfortunately, he was talked out of it. And I think he was talked out of it by the dealer community here in New York City who didn't want to hedge it. But I think it was a mistake, personally. It was a missed opportunity. They had the right idea. They just didn't execute on it. I hope in the second administration, Trump administration, they'll seek to at least slowly start to move to extend the maturities of our debt for the long-term fiscal health of the country.
You've heard some of the names, I'm sure, about the people that could possibly head the Treasury. Do you think that that's a possibility, that they'll think about this differently? Donald Trump is looking at Wall Street people to head the Treasury. Do you think we could be entering a different time and a different way of looking at things?
I think so. I really do think so. And I think I don't want to cast aspersions on the current Secretary of the Treasury, but in my opinion, she's behaved in ways that are more politically oriented, more politically motivated than perhaps in ways that would be in the benefit of the long-term interests of the economy and the American taxpayer. And I think it's good that you have people with market experience, especially now, people with market experience in that role. We just had a conference 2 weeks ago, or a week ago. It seems it's like 4 days ago. I don't even. It was in London. I think it was last week, last Thursday. I've been everywhere, but we had it with Liz Truss, and Liz Truss, former Prime Minister of the UK. And we had her speak to our clients specifically because of this idea that she was there when the bill came due in the UK, when the bond market vigilantes really kind of forced her hand, and that's important. It's instructive. And again, U.S. has reserve currency status, so you get away with a lot of bad behavior when you have the reserve currency. But it's not. There are limits to what you can get away with. And I think having a markets person in there makes a lot of sense, because this is going to require a certain amount of flexibility, I think, intellectually, and a good understanding of the markets to get through this without a lot of pain.
It's and talking to you about this, it occurred to me that if you do the longer, even a 20-year bond, you add a new group of people like retirees who are saying, oh, you know what? If I can do 20 years at 5.5% or 5%, I know that's coming in. This is a whole new group of people you have buying bonds. So, and talking to you, that light went off in my head. I don't understand why it doesn't go off in the Treasury's head.
I think it's really I honestly believe it's political expediency that at the margin, it kept the deficit a little bit lower by issue, especially when the Fed was engaged in QE. It was just cheaper to issue shorter term debt. But the problem is that once you start to have an inflation problem and the Fed has to raise rates, that benefit turns into a detriment, because now the weighted average cost of our debt, not to get too in the weeds here, the weighted average cost of our debt is below every part of the yield curve. So no matter where we funded it, even if we continued to fund it with bills, our interest expense would rise because we have committed ourselves to so much short-term funding that anywhere we would fund it, it would increase the interest expense on our debt. And so, again, no one, in terms of, not to be overly simplistic about it, but certainly any person that was taking out a mortgage, if they had an ability to fix their long-term interest rate at very low interest rates, would take it out as long as possible. Uncle Sam basically took out an adjustable rate mortgage on its future, and it can get away with it, but it's not without cost. And the cost is the potential for higher government spending, higher deficits, higher inflation in the long term.
So we've begun the easing cycle, if you will. We've had 2 rate cuts. What do you expect? First, let me ask you, do you think the Fed has done a decent job here?
I don't think, certainly I think you have to give the Fed credit for engineering a soft landing thus far. So I really, you have to give credit where credit is due. My own hope is that from here they'll be a little bit more circumspect with some of the rate cuts that they're talking about. Before the election, there was an expectation that the Fed was going to ease another 4 or 5 times before the end of 2025, bringing the Fed funds rate below 4%. I hope they tap the brakes on that, my own opinion, because I am worried about a second wave of inflation. And there are some signs of excess, especially now. Just before I came in here, I saw that I think it was Christie's just sold a banana duct taped to a canvas for $6.2 million. You read stuff like that, you say, maybe rates are not, maybe rates are too low rather than too high. And again, but I'm all for rate cuts, but I do think that the Fed should proceed cautiously. I give them good marks so far, but I think that the primary responsibility of the Fed is to preserve price stability, and that's especially for working class and regular people, who have seen a deterioration in their standard of living over the last 4 years because of inflation. So it's wealthier people can hedge inflation; it doesn't affect them as much. But the average person, I think it has a very meaningful impact on their standard of living. So I hope the Fed focuses on that above all else.
So a banana that's going to turn brown and start to smell after a while.
I don't know. I'm in the wrong business.
You and I both.
I'm not the most artistic person, but I could probably handle that. So
are you expecting a rate cut all year long, Jason? We've heard data. We need data. We need to watch the data. It took them a long time. I heard rate cuts over the summer. We got one in September. We got one in October. Now we come to December. Do you think we'll get one, or do you think the data is telling them, you know what, just hold off a little bit?
Yeah, I think we talked to our chief economist, Don Rissmiller, this morning. I asked him that question specifically. He thinks it's 50-50 for December. That it's certainly no slam dunk. And I think it's also partly because you have a new administration that is going to depart pretty meaningfully in terms of economic policy from the Biden administration. And so if in terms of just being cautious and waiting and seeing, I think it makes some sense to wait and see what the new administration is going to do before I start planting my feet and committing to significantly more rate cuts. And I don't think they'll lose much in waiting a meeting. They'll have a much better idea of who the players are, what the policies are going to be. I don't think they're that hard to figure out, but I also think it's not a bad idea to wait and see for a little while. I don't think there's a big harm in doing that.
Given where the CPI is, about 2.4, what do you think a reasonable floor is for the interest rate at this point?
Well, for the Fed funds rate, I think it should. I don't think it should be any lower than 3.5. It should probably be more. In my opinion, my own opinion. If I were running the Fed, my target would be something more like 4%. If I'm looking at 2.5% inflation, I'm not convinced that 2.5% inflation is a necessarily a sustainable level given economic policy currently. So, I think the chances of another wave of inflation are not low or not trivial, and it's partly because a lot of working people have really been left behind by the inflation that we've seen thus far. And so, if you look at some of the wage negotiations, whether it's the Longshoremen's Union or whether it's the machinists at Boeing, you can see the wage concessions are, in the case of Boeing, it's 38% over 4 years. In the case of the longshoremen, it's 62% over 6 years. Those types of concessions are not consistent with 2% inflation. And not a big portion of our workforce is unionized, but still that sends signals to other people in the workforce. And so I'm not saying those people don't deserve it. I think they're part of the reason why they're getting those concessions is because they're making up for lost time. But that's why the Fed should proceed carefully, because once inflation kind of gets going, it gets hard to stop it because there are natural tendencies for it to keep going.
What's the lag time, Jason, between oh my God, we saw the numbers start to jump. If the Fed, initially Jay Powell was a little hesitant to raise rates. I don't think he can be as hesitant if he's still Fed chairman, but the Fed can't be as hesitant to raise rates to keep that under control, could they?
I don't think so. I think the Fed's credibility would be very much at risk. I think you might get the first one for free. The Fed's reputation took a hit, but it's still a pretty well respected institution. People understand that COVID made their job very, very difficult in terms of the amount of spending that was government spending that was taking place. But I think the next time around, I'm not so sure people will be as understanding if the Fed misses another wave of inflation. And that's easy to do because central bankers are human beings. It's no fun to tighten. It's certainly no fun to tighten when it's not obvious that you should be tightening, right? So it's one thing if there's a financial crisis and you ease, that's one thing, or it's one thing to tighten if inflation is 9. But it's very different if inflation is 3 or 3.5 and you're tightening. Not everyone will understand the rationale for that. But again, as Bill Martin said many years ago at the Fed, the Fed's job is to take the punch bowl away before the party really gets started, right? So you're a little bit, you're not the most popular guy at the party, but that you have a deep responsibility to the American people to preserve price stability.
Well, in your eyes, what's a reasonable inflation rate? 2%, we've been trying to get there for a while and haven't been able. Yeah. We've gotten close. What's reasonable, do you think?
Yeah, listen, I think, and the irony is the 2% target was established. There's no science to it. It was established actually from a New Zealand central bank paper in the early 90s, I believe. And frankly, the 2% target was only really discussed when inflation was serially below 2% after the financial crisis. So it was never really discussed much before then. Lower was better. But over the long term, over the last 67 years, the average inflation rate is more like 3.5. So I think anything, I would prefer something in the 2.5 to 3%. I don't think it has to be some sort of suicide pact with 2%. I think the direction is important. I think keeping track of price stability is important. But you want it as low as you can go, I think, without risking some sort of financial crisis. You don't want to be overly tight. By the same token, inflation is a tax on people, on savings, right? So especially, again, as I said, working class people, middle class people who don't have necessarily a lot of savings, especially in levered assets like private equity or venture capital or something, they feel the brunt of higher inflation. And that's why it's very important to, again, that Fed has a very solemn duty, it seems to me, to keep inflation in 2.5 to 3%. To answer your question, it seems to me to be a reasonable goal. And you could look at it over a cycle, and you don't necessarily, again, it doesn't have to be necessarily a hard and fast rule, but that should be the long-term goal.
In your research, you talk about the common man CPI. Can you explain this to us and what you mean by that and the correlation between that and what the Fed looks at as the CPI?
Yeah, it's funny because as you know, when CPI is reported, they report it as headline, and then they report it as core, which excludes food and energy.
Right.
And then earlier this year, they came up with something called super core, which excluded food, energy, and shelter. And I don't know about you, but eating and staying warm and staying out of the elements is pretty core to me. So we got frustrated by this because I also think there's a political angle to this because most people, again, those things are very core. So what we did is we looked through the subcategories of the CPI and we just decided what do you have to spend money on come hell or high water and what's discretionary. So the common man CPI just counts the things that we all must spend on every day, every week, every month. So it's food, energy, shelter, children's clothing, utilities, and insurance. So everything else we don't count. So flat panel television screens or trips to Barbados or any of that stuff. And it's important because I think it has a political implication because that's how the average person is feeling about inflation. And so again, in my opinion, that's part of the reason why the attitudes on the economy were not particularly good. Sentiment wasn't good, despite the fact that on the surface it looked quite good. Unemployment rate was low, inflation came down, stock prices were high. But again, if you're part of the 40% of the people in the United States that don't have, let's say, an equity portfolio or not exposed to the financial markets or might just have savings, it hurt, right? So that's why we created the index, is partly to understand, those folks and what they're going through from a political basis, but also to focus on how well the Fed was doing on the things that really matter for most people.
It seems to me that that's the smart thing to look at, although some would look at a flat screen TV or a trip to Barbados as a necessity. It's really not. But
Right.
Those are the things that are necessary. I mean, housing, which is totally out of control, and with the 10-year, housing prices, mortgage rates, they're all way higher than a lot of people can afford. How do we get that under control?
Yeah, no, I mean, the irony really is that mortgage rates have increased meaningfully since the first Fed easing in September, right? And so they're up about 40, 50 basis points, if I'm not mistaken. They're close to 7, I believe, right now. And it's a very tricky problem because there are a lot of reasons why there's a certain there's a bottleneck in the housing market. Part of it is just because interest rates rose very quickly, and so you have a lot of people that are quote unquote stuck in lower interest mortgages. I also think the immigration policy over the last 4 years has not helped the housing market, right? Because you have, depending on who you're listening to, another 15 million people in the housing market, and so that soaks up some supply as well, right? So everything is at the margin. And so here, it's not a particularly easy thing to fix, right? Or it takes time. Their estimate is that we're probably short somewhere between 4 and 5 million single-family homes. We manufacture single-family homes at a rate of about 1 million a year, maybe a little less than 1 million a year. So the bottleneck in housing is meaningful and is not easily fixed. And so it's really, I wish there were a better answer, but it's really more of a function of time more than anything else.
Do you see that easing a little with the new administration's policy of I want to say exporting or these illegal immigrants or giving them back to their homeland, I suppose? Could that ease a little quicker?
It could. That's and again, I want to say I'm not absolving the incoming administration for anything that happens in the future, but they're inheriting some very, very thorny problems. Immigration is one of them where it's not easy. There aren't a lot of, once you've done this, once you've essentially had open borders for 4 years, the the administration, the Trump administration that's going to have to clean it up, is going to have to make some very difficult choices that are not perfect. So, for instance, if you start deporting 15 million people, 10 million people, that is likely to increase inflation, right? Just because it relieves some pressure on wages. If you allow all those people to stay, that could also increase inflation to the extent to which a lot of these folks are going to start to use credit now, which they haven't used before. So we'll start to apply for home loans or auto loans or all the rest of it, or we'll just consume government resources, right? So this is not easy, it requires. I don't know if there's a good way to do this. I'm certainly not an expert on doing this, but I do think that I do think, at least at the very minimum, slowing down greatly the amount of illegal immigration and deporting bad actors will probably have some positive impact on the housing market.
So I was reading about credit and credit cards, and obviously President Trump wants to put a cap on credit card interest. And I was reading that could cause credit card companies to start canceling credit cards. So that would tighten credit, and that would be a drain on the economy as well, because now people can't spend as much as they used to because they don't have that credit. They don't have the cash, but they don't have the credit either.
Yeah, I'm not a big fan of price controls, and whether those are price controls on groceries or price controls on money, on interest paid on the cost of money. And so I understand the impulse because these interest rates are, pretty much in the usurious levels. You're looking at 25%. By the same token, again, it's as you're pointing out, the credit is only available probably at those types of interest rates for some people. And so I think, again, I'm for free market capitalism. I think markets tend to do a better job of organizing an economy than the decisions of relatively small groups of people. Especially small groups of unelected people, like at the Federal Reserve Board, right? So, I would rather see just more market influence in the economy. I think the incoming administration is much more pro-market in that regard, but I would resist the temptation to try to fix everything via the government, because I think, as we've talked about before, once you start going down that road, it's very hard to get out of it. We should be moving back to less government, more markets, and then, of course, having a strong rule of law, punishing the bad guys, all of that stuff. But I think the price mechanism, the incentive system works exceedingly well.
I thought it was a great idea, but I didn't look at it from the credit card company side, right, where they said, okay, you know what, we'll just cancel credit cards. So it's a very slippery slope. Maybe not 10%, 15. They have to be able to make their money, obviously. So
right, you're balancing. The credit card companies, and again, no one's a big fan of credit card companies. I mean, in terms of what they're charging, and I'm not defending them necessarily, but it's a business, right? And they have to balance the potential for loss with the interest rates that they pay, right? And so that's kind of the way it works. And again, as I said, I'm kind of more for free markets than anything else.
So in Donald Trump's first term, stock market went from about 20,000 to 30,000. During Biden's term, 30,000 to 42, around there. What are you expecting over the next 4 years?
Well, listen, I think it's hard. Those are difficult. Both of those acts are difficult to follow, right? Up 50% and up 100%. And I think you do have to remember that a lot of that was driven by the fact that you had the Fed's balance sheet, assets on the Fed's balance sheet went from about $4 trillion before COVID to $9 trillion after COVID. It's now about $7 trillion. So, and our debt increased dramatically, especially over the last 4 years. So it's hard to expect those types of returns from here, in my opinion, because it's difficult to pursue those monetary and fiscal policies without stoking another round of inflation. So I think investors should lower their sights a bit, hope for the best, but also prepare for the idea that returns will probably be more in line with historical averages, which are generally, as we talked about before, in line with profit growth. So profit growth over a longer term is, about 6-7%. I think a 7% type of compound annual return on the stock market during the second Trump term would be fine. I know there's nothing wrong with that. That's actually quite good, especially if you're keeping inflation at bay. So your real return would be something that would help people build wealth. But listen, wealthy people have done exceptionally well over the past, really, especially over the last 4 years, but really since QE started. And I'm more concerned with the people that don't necessarily have stocks, don't have private equity, don't have venture capital. Those are the people I think we have to spend a little more time worrying about. And I'm convinced that by not worrying about those people so much, it's part of the reason why there has been such a strong populist element to our politics. One of the great ironies, and I think the Fed would faint with my saying this, but the Fed's policies, I think, directly led to Donald Trump's appeal to regular people, because they didn't feel that they were getting their fair share of the economic bounty. The economic bounty was largely accruing to the wealthiest people. And so that's not, it's one thing if that happens naturally. It's another thing if that's happening from government policy. And it shouldn't happen via government policy.
I think so many people look at the stock market and mistake that for the economy, and it's not exactly that. It's not that way at all. But a lot of people, they talk about the Fed, they talk about interest rates, they talk about interest rates, companies borrowing money at a higher rate, but then they equate it to the stock market and the stock price going up and down, and the economy is totally different than what your stock prices are looking at.
Absolutely. And again, you have to remember 40% of the American public doesn't own stock. So, to them, what is most important is their take-home pay. We would call it their real wages. So their wages after inflation, right? For a good portion of the population. And that makes sense, right? So you want to be able to save something after you've paid for all the things that are necessary for you. And that has not been the case over the last 4 years as inflation spiked. People were worse off after inflation than they were before.
Yeah, it's interesting that after the common man has paid for the things he has to pay for, you want a little bit extra put away.
Of course. And that's the way, it's the way it should work. And then, enough savings equals investment, right? That those savings get turned into investments or bank loans made by banks or other investment vehicles to fund capital expenditures and other things that create wealth and productivity. So we want a society in which we're encouraging savings. It seems to me. And consumption is great. Americans are great at consumption. It would be great to see Americans a little better at savings.
Well, Jason, thanks so much for joining me. I really appreciate it. Where can we find you, either on social media or Strategas on social media, or research that you guys do?
Yeah, so for me on social media, on Twitter, it's @JasonTrennert_. And for our company on social media, it's @StrategasRP. And those are the two places you can find us. We also have a website, www.strategasrp.com. So we're not hard to find. So we encourage everyone to take a look at our website and what we're doing here.
Well, Jason, thank you so much for joining me. Look, I want to wish you a happy holiday season. We're right on the corner. So I hope all goes well and you enjoy yourself.
For you as well, sir. Thank you very much.
Thanks so much for watching our discussion here on Wealthion with Jason Trennert. I hope you enjoyed the discussion. If you're looking to grow your wealth or are in need of help being financially resilient, please head over to wealthion.com/free for a free no obligation portfolio review. And of course, if you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you know when we post new videos on the channel. And please, do the social media thing with us. All the links are in this description below. If you like this content and are looking for more ways to achieve long-term wealth, watch this video next. Until next time, stay informed, be empowered, and may your investments flourish.